Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on how much longer he expects the Canadian dollar to rally. Wall Street Window editor Mike Swanson explains why he believes the shine is back on gold. We'll talk to Ross Clark right after this.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
It's nice to be with you, Jim, and another one of those weeks with a lot of activity.
Ross, do you feel people should be paying attention to credit spreads right now?
When we talk about credit spreads, it's the differential between various qualities of credit and what those will demand in the way of interest from the investors. So if one takes a look at the government T-bills and bond market and the rate there and looks at, say, a triple C corporate, that spread had widened from about 6 points out to over 20 points in the last year and a half. That's the difference that a company with poor credit is having to pay over and above what a government rate is. Now, the spreads widened out in the summer and came to a peak on October the 1st, and as they started to narrow in then, we got that great lift off the bottom in October. Now, the same thing has happened here in the last couple of weeks. Credit spreads peaked out around February the 12th, right into the middle of the month, and that's the same spot at which we've seen the equity markets go in and create what became a double bottom, where I thought it might eventually become a triple bottom, but we got a double bottom there. And the spread between the high yield and governments has gone from 20.66 and dropped by about 1.5 points now, which is very, very good. And that then has taken us from the risk-off style of marketplace that we had, where everybody was sellers of product in the equity markets, to a risk-on attitude, which has fed through into just about everything in the markets.
I've heard about the Golden Cross. Can you explain what it is and what it means?
Golden Cross is very simply just the difference between the 50-day and the 200-day moving averages, and as the 50-day moves above the 200, that would be called the Golden Cross, a bullish Golden Cross, and when it moves below, then that becomes a bearish one. And in a trending market, the shorter-term moving average will invariably spend most of its time above the long-term average. And even during corrections, maybe it'll kiss down underneath for a very short period of time, but in general, it stays above. Now, this week, gold, for the first time in a couple of years, managed to have its 50-day moving average cross above its 200. That happened in the middle of the week. And the media took notice of that. There were many, many reports out saying how bullish this is. But when I do the research on it, we look back and we see that it's really got a bit of a checkered past. Only about a third of the bullish crosses in gold have resulted in sustained moves of more than 2 months. And in virtually all instances, by the time that the 50-day crosses the 200, you end up seeing a price high within the next 5 to 15 trading days. And when we look at the bull markets, where we had come off at least a 1-year low, where the price had been below where it was 1 year earlier, we've got the good examples of 1975, 83, 1990, 93, 99, and now this one. And interestingly, in every single one of those, there was a top or an interim peak in the first 15 trading days. And from there, corrections, we saw drops of anywhere from 5 to 14% before the market was capable of then rallying on once again to the upside. So here we are at the end of this week. We've got 3 days at this point since the crossover. It would be normal that by the end of next week, beginning of the following week, we should have seen an interim peak in the gold market. And with some of the other items that we look at, like the commitment of traders, which continue this week to see marginal increases after big numbers 2 weeks ago, that continues to keep them into an overextended level so that the market becomes vulnerable to any negative news that might be out there.
The loonie has hit 75 cents American, a nice climb. But is it the loonie going up or the U.S. dollar going down?
Or is it the oil market going up? It's all one big picture. And we put out a piece this week on the Canadian dollar, specifically looking at the fact that it has rallied back decently, and it's actually now creating on the weekly charts some overbought signals. Now, in bear markets in the Canadian dollar, typically the first good overbought signals, and we had one March 15th of last year, you'll see the dollar top out literally within days of that signal on the weekly charts. But when you get then another 9 to 15 months later and you get your next good overbought, which is what we're starting to see now, that will stay in place usually for 2 to 3 weeks before the dollar rolls over. Now, so here we are, we're at the end of the first week with overbought in the Canadian. I would suspect that you're looking at a high, as I say, probably within the next 2 weeks, and that coincides with what we're seeing in the oil market. Our target off the tested low in the oil was that we'd get into that $35 to $40 range. We've closed off this week 36 and change, and it's starting to show some overbought readings. The other aspect that we see as well, if you take a look at the materials index of the miners, you take a look at an XME or the SPTMN in Toronto, they've gone into overbought territory. So pretty good chance, I would say, that this first run off the bottom might run out of some steam within the next week and a half.
Ross, thanks a lot for chatting with us.
As always, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, Wall Street Window's Mike Swanson on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome to This Week in Money, Mike.
Oh, thanks for having me. It's great to talk with you this week.
Mike, could you first of all tell us a little bit about Wall Street Window, what it does?
Oh, well, it's a financial website. I've been running it for 14 years now, and it's really got two components to it. One is a pay premium private membership area with stock market commentary, detailed trading ideas, and so forth. It has a weekly PDF report. That's one of the things that evolves. And then the rest of the website, if you just go to Wall Street Window, it's free blog posts about what's going on in the market in any given day, and also in the news world a little bit too. And if people too, they can opt in and get a free monthly newsletter for doing that also. A lot of people charge like $47 for that, but I just do that for free. So that's what's at the website. Thanks for asking.
Mike, gold is getting the most attention, I think, on the markets. What can you tell us about gold this year?
Well, it's really quite amazing. Gold just out of the blue in January just took off like a rocket. And actually it's kind of funny because right before it did that, the mining stocks actually fell and made a new 52-week low for a day or two, and then suddenly reversed and took off like gangbusters too. The GDX gold stock ETF went down below $14 or below $13, and now, as we're speaking today, it's right under $21, and that's an incredible return in less than 2 months. And the situation with gold and the mining stock is they, of course, had been in a bear market for several years and really based for about a year in the 200 and 150-day moving averages flatten out during that time period, which is a characteristic of especially commodities after a long bear market. You often get these long basing periods. And during that time, because of the big losses of preceding years, almost everyone is negative. They've lost money, and people that weren't in the market have no interest because, generally speaking, the general public is only interested when something goes up, and they like to chase things. So they lost total interest in gold. It was quite different in 2011 when even Jim Cramer was on CNBC at times telling people to buy gold and Newmont Mining and so forth. So anyway, that's the environment we came in this year. And then just out of the blue, it just took off. It broke through the 200-day moving average, and as I mentioned, we had this tremendous rally in the GDX and the mining stocks. Now, gold itself is knocking on 1,300 when it was below 1,100 back in January too. So these are big returns in a short amount of time, and it's very tempting for people to say, well, this is just unsustainable, and it's gone up so quickly. And there is some truth to that. The problem is, you could have said that a week ago or 2 weeks ago, and that's how new bull markets start. They just go off like a rocket. That's what happened in 1982 to the U.S. stock market. It's what happened in March of 2009. And the psychology at the beginning of a bull market is for people not to believe the move is real, or to some people who even try to hedge positions they own or bet against the market, thinking you're still in a bear market and they're looking for a pullback. And I see people doing that on the internet and talking that way. And I can remember myself in March 2009, I fell into that trap when it came to the U.S. stock market because I had been bearish on the market in 2008. I actually shorted the market into the crash, but it's easy when you are right about something to take some time to adapt when things change. So that's what happened to me in 2009 in March. I didn't start to go long until June, and the market had already gone up quite a bit. So I missed the bottom, technically speaking. And I'm bringing things up because I think there's lessons everyone needs to take from what gold has done here. First of all, it, as I mentioned, it just shot up out of the blue. I don't know a single person who predicted that gold was going to go into a new bull market in January like that. Now, I've been saying for months that I was expecting a new bull market to start, but I couldn't predict when. I knew we were at the end of the bear market. We were basing, but I couldn't tell you the day or hour it was going to happen. But here we are, and when you're in a new bull market, the thing to do is hold core positions you own. So anyone in gold, I think they need to be happy, very happy, and have some core position that they can hold. And to be able to do that, it has to be a position that's not so big that it makes you lose sleep or get scared if gold were to pull back 10% or the mining stocks pull back 10 or 20% or so forth. So don't go on margin at this point and just be happy. And if you don't have any positions and you want to get into this market, the thing to do is buy dips and pauses. The problem is that we can't predict either when that is going to exactly start. And I think the best comparison to what's going on is 2009 in the U.S. stock market, because it went up from March to June, or went up a couple months before it pulled back, and that's what this seems to be doing. So I really don't think this is the top today. I think gold's probably going to go through 1,300 at least, maybe even up to 1,350 before we do see a top, so the gold stocks can go higher. But, it may not be until a couple months from now that we get a dip or a pause that makes for a safe entry point. And that's one reason why when you have a market that you are looking to actually invest in, that you think, and you have to have a good reason to think that that it's going to go into a new bull market, that the bear market that's going on is over. The best time to invest is after a bear market. The problem is it's impossible to time when the shift is going to take, so you risk losing money by investing before the next bull market starts. And gold, it's been tough for people to invest in it. And the only way to do that, again, is to just have small enough positions where you can be patient and not worry. I even got an email from someone who said they bought gold last year and they sold out before the move started because they simply got impatient. So you have to be patient. You want to be a long-term investor. Now, you also have to invest in something that's in a good investment position. And if we turn away from gold, gold tends to go up. Gold is a commodity, and so is silver. They're precious metals, and they go up in a cycle related to the entire commodity market. And typically, what happens is when an entire bull market in commodities begins, it begins first with gold going up, and then other precious metals follow. So that's a very important thing for people to keep in mind, because that means that other commodities are going to do what gold has done and go up too. And they haven't started to do that yet. So there's a great investment opportunity in commodities in general right as we're speaking. So if people miss the move on gold and they need to wait for a pause, but they can invest in other commodities which haven't yet gone up. And my favorite thing right now for anyone to buy and invest in are agriculture commodities. And I own some. There's exchange-traded funds that invest in them. DBA is one of them. RGA is another one. And I think those two ETFs are in the same position gold was in at the beginning of the year. They've been also in giant bear markets, but the move to the downside has kind of very slowed down. They've been consolidating and going sideways, and you can draw a resistance trend line on the highs. They're about to make an attempt to break them. If they do, and if they go above their 200-day moving averages, I think they're going to start a move just like we've seen gold do. So there are really exciting opportunities right now for people who want to buy something and invest for real. And you do that by buying something after it's had a bear market. It's cheap and so forth. And also add that the commercials that in the futures market, the commercial traders, they tend to be right at key bottoms and tops. Not that they're not. This is a thing. It's not great for exact timing, but in January, well, actually in December, the gold commercials reduced their net short positions to levels not seen in over a dozen years. You got to go all the way back to 2000. So that was a huge tip to us, a sign that something was going to change. They had positioned themselves ahead of the move. The move didn't start for a month later, but they were positioned for it. Now, with most agriculture commodities, they have done the same thing. In many agriculture commodities, the commercials are either very low net short, in some cases net long, such as the instance with coffee. That's been like this also for several weeks. And again, this is not an exact timing indicator, but it does suggest that the smart money, the commercials, the hedgers, the producers, they're positioned and prepared for a launch in commodities just like we've seen gold launch. Now, oil tends to be the last commodity to go up, and so I don't think oil is exactly in this position to start the bull market. If you look at the last the 2000 to 2003 commodity bull cycle, or the start of it, and then the last one, oil actually went up last. The gold stuff bottomed in 2000, in the fall 2000, and did really well for years, but oil didn't start a bull market to 2003. It took 3 years. I think it'll be another year or two before oil really goes into a real bull market. It's likely just to go sideways, retest the lows or whatever. So it's not interesting to me to buy oil, but I'm very excited about gold, silver, and agriculture commodities.
Mike, what do you like better, gold bullion or gold stocks?
I actually own both. It depends on what a person is trying to do and how much volatility can handle in a portfolio. The gold bullion is going to move up it won't move up as much as the mining stocks, but it won't fall as much either when the mining stocks have correction. So I think for a really conservative person, they should have 10%, probably 20% actually of their money in gold. The gold stocks just move a whole lot more. You have to watch them. I think later this year, though, when there is a pause or pullback, there'll be individual mining stocks that'll be screaming buys for people who like individual stocks. You know, they're willing to buy something, you know, and risk 10% or something to try to double or triple their money even. In the junior mining market, those type of gains are going to be possible. But those are more speculative stocks, more dangerous stocks, so I guess you could put it that way. So someone is just simply looking for like an asset allocation. Like say you have an investment account, and you know the typical American has 50% of their money in stocks, and let's say 50% in bonds, or even worse at this point, like 70-30 and so forth. You know, you hear these type of things. As you get older, you should have, you know, more bonds and less stocks. If you're younger, have 80% or 90% in stocks, and then the rest in bonds. And that's what most Americans do. In reality, for people like that, gold right now is what they should have in their portfolios as a core part of it. I think it's actually going to become a necessity in the years to come, because at some point we're going to see a bear market in the treasury bond market, and I actually think we're in a bear market in the stock market, even though we have been getting this bear market rally over the past couple weeks. And I actually think this rally is going to end up being the worst thing to happen to most individual investors in the United States, unfortunately.
Now, is this the kind of rally that somebody would call a trap?
I definitely think it is. I believe the stock market topped out last July for there's three things that tend to make a top. Overvaluation, which we saw the cyclically adjusted P reach a level only seen 3 other times in the U.S. stock market. And then you get internal deterioration where fewer and fewer stocks even go up, and they actually go into bear markets and fall. But people don't really think about it or notice it because the averages continue to do well as they're being held up and helped by fewer and fewer stocks, but the stocks help them. That's what happened last year. In fact, by the end of the year, it's only stocks going up with these so-called FANG stocks, Facebook, Amazon, Netflix, and Google. And you could hear people on CNBC say, oh, these are the safe haven, and you don't have to do anything else. Well, all this is bad, and so in January the market dumped. But in the third thing is a technical breakdown, and that's really what happened in January when the averages tipped down and they went below their 200-day moving average, below their 150-day moving average. They did the opposite thing that gold has done. You see, gold in January been below the moving average for years, and then broke above them. So that's a huge giant trend change in a long-term trend, very significant. And the stock market is the opposite. The stock market had been above the moving averages for several years, and then in January decisively broke through them and had a very big dump. Scared people while it was going on. In fact, there's one day where the Dow was down 500 points in January, and I actually got someone that called me on the phone where I live telling me that their family was thinking about selling every stock they own and getting out of the stock market. They saw the market fall and the Dow down big one day. And I told them, I don't know. You know, it's already fallen. You probably get a short-term bounce to get out at a higher price. The problem is the bounce did come, and now we got to, then we retest the lows, and we got this other bounce. We've rallied back up to the moving average. As we're speaking, the S&P 500 is at 2,000 at this moment. Who knows if that's going to stay there by the end of the day or what. But in bear markets, the 200-day moving average is a critical resistance point. It's when you get there to sell stuff you don't like, moving stuff that's better. Well, bet against the stock market. I'm doing all these things. I'm betting against stocks I think are junk. I have, as a way I'm managing my money with different asset allocations, I'm short the stock market while I'm long gold and commodities and mining stocks. But the problem is that people like the person who called me on the telephone, they have now they have no worries about the stock market because it's gone back up and the TV is bullish. In fact, the advisory services, investors intelligence, and so forth, that poll investors show that more people are bullish on the market than bearish now. It wasn't like that a few weeks ago. So all the worries are gone. And the biggest problem is this just creates this complacency where people just get lazy. They feel like they don't have to do anything. I can just hold my stocks. I don't have to make any changes. And then the sad part is most of these people, the market will fall and say, later this year or even in the spring, the lows are broken and the Dow's down 500 or even 1,000 in a day. That's when people will sell. When in reality, it's not simply losing money. At this point, that is a big problem of people who just remain trapped in the stock market. It's they're missing out on opportunities to invest in things that are really going up now and really working. And gold is the main thing. So the people that are like, oh, I'm diversified. I've got, most of my money in stocks and most of my money in bonds. They're missing out now on gold, and they need to get in it. And they need to get out of these bad stocks. And the funny thing is, those bad stocks, the FANG stocks I mentioned before, they're actually been lagging the market over the past couple of weeks, and it's a good possibility that suggests that when the next decline does come, and I think it'll start this month, they can lead the way to the downside. And those are stocks so many people simply own because they think that's the best thing to do.
One of the major Canadian banks used this term. They said people should take a chill pill if they're worried about the economy. Well, is worrying about the economy not a good idea?
Well, I don't think people, I don't think people, I don't worry about the economy, about myself. You should just focus on the trends of the market and what these big, trends are. What stage is the market in? Are you starting a bull market? Are you in a topping market? And then make your investment decisions by that. Now, the problem is people do worry about whatever the news then is of the day, whether it's economic news or terrorist news or this and that. And these things, news stories can have a short-term impact on the market, for a day or two. But I've never seen a news story, even bad economic news for that matter, cause a brand new bear market or a brand new bull market. If you think about 9/11, the stock market was already in a bear market, and 9/11 didn't cause the market to continue to drop until that summer of 2002. So people, that's the real problem. Is people just get caught up reading news stories, trying to figure it out, look at the market today, why is it up or down, try to figure that out, instead of focusing on the big picture, which is what is the big trend of the market. And the big trend can be identified by looking at a daily price chart that goes back a couple years and put the 200-day moving average on it. Is the market above it or below it, or just like floating, holding up on the moving average? Is the moving average, going sideways and the market's just kind of bouncing up and down through it and over it, which is what it was doing last year. And when it's doing that, that's a sign that you're in a topping market when that's been going, when you've already, seen gains for years. And the opposite, when you've had a bear market with losses for several years, then all of a sudden the averages flatten out. That's a sign that you're basing and you're going to have a bull market ahead of you. That's where gold was. That's where the commodities are now. And the stock market has been below the moving averages since January, beginning of January. Bounced back to them. It's resistance. You got to trust the trends. And the other mistake people do is being all in one market or one trend, and that's the biggest mistake people make, because it makes you so dependent on that one thing that when it moves against you, you panic and get out. So the solution is to be diversified at multiple markets, multiple asset classes, and so forth.
The Canadian government has sold off the last of its gold reserves. Bad move, considering what you think of gold right now?
Yeah, it's a pretty bad move, but it's par for the course nowadays for central banks. It's kind of funny, you know. Everyone's looking at the presidential election in the United States and the chaos of the Republican primaries, and what that chaos really represents is a failure of the establishment controlling the Republican Party for the past years to do things. I mean, the Bush administration was a failure, and the Obama administration too. But people are so angry at these politicians that they're, you know, voting for Trump. But these same sort of failures of the politicians and the government leaders has been going on with central bank policies for years, and they even have worse consequences for what, you know, the president does when it comes to the economy. And yeah, it's a giant mistake. And that begs the question though, what other mistakes are being made by central banks? And there's a lot of them. And that's one reason why people are piling into gold now. Let the Canadian Central Bank sell off their gold. And what's happening now is people all over the world are buying gold. They're buying into the GLD ETF. We saw some of the biggest inflows in that ETF last month ever. I think it was the second biggest inflow ever for that ETF. So investment money is flowing into gold. People should also be asking, what's the reason for that? And it's because central bank policies, you know, are put the whole world in a bad position. People don't see that yet. The stock market, for most people, they still believe in it, even though they've been losing money and continue to lose money this year. They still believe in it. But if the market goes down again, people will start to wonder what's going on, what's the reason for it. But the smart money is piling into gold, not only because it's in the bull market, but because it's breaking away from the U.S. stock market. It's also breaking away from the treasury market too. So it's acting as an asset that isn't trading at all with anything else. That makes it a safe haven from stock market instability created by failed Federal Reserve policies. This instability hasn't really started yet. Only a few cracks in the market have so far emerged. You think of the drop last August. That was so sudden, but it went away and forgot about it. The drop in January was so sudden, over 2 weeks, but it went away and everyone forgot about it. But let it fall again, and people will then wake up, you know, and they won't be forgetting these things anymore. But right now they're asleep. But people in gold are positioning themselves ahead of this. So they're coming out of stocks and going into gold. When gold goes up, they got to ask themselves, where's this money coming from going into gold? It's coming from people that are slowly trickling out of the stock market. The thing is, with mining stocks and with gold itself, you know, they are a fairly small asset class compared to the entire global economy, all the currencies and all that. So it only takes a little bit of money or a small number of people doing this to make gold and silver rise like they've been doing.
Copper has made quite a gain over the last couple of weeks. Is that an indicator that the world economy is actually better than many people suspected, or is it just a seasonal move?
Well, I think it's linked to, it's one thing that's interesting. I have a different take on it, that normally copper is linked to economic growth. So copper prices, you know, have been falling for years, and now they're rallying. I see that rally as part of an overall rally in precious metals and not a sign of economic growth for the world economy, because there are no other indicators that support that. If such indicators appear, then, then you know, I would change my mind. The problem is that tends not to happen until, you know, the economy starts growing. Economic indicators lag, so people who try to forecast the economy are essentially guessing on the future without any real data. They're just guessing. So I really can't predict what the economy is going to do. But the thing is, what is interesting is we have seen a big economic slowdown, and there's been talk of deflation this year. And there actually has been deflation this year, especially in China. Now, what's interesting to me, though, is that that deflation can at some point suddenly change and go up, not necessarily because of economic growth, but because the Fed, if the stock market declines, will stop raising interest rates or take away their interest rates, and as the decline gets big enough, they'll end up doing another quantitative easing program, and they call it something else. And there'll be inflationary policies all over the world. We've already been seeing that. The Bank of Japan did another quantitative easing. China has talked about intervening. So I think what we've seen with copper and other commodities is an initial decline this year based on economic weakness, but a bottom and a rally that won't be based on economic growth, but based on inflation, a need to get out or to buy these things, profit from inflation or hedge against inflation and so forth. Inflation not created by economic growth, but by the failure of central bank policies all over the world. What the specific failure is the central banks, in particular the Federal Reserve, over the past year have promised or talked about saying we're going to get into a normal economic environment of stability, return to one. And they say we even had that since 2008. And we've had to intervene and do these things year by year. We've had crises in Greece and China now blowing up and so forth. And they're saying things are going to get more stable and we can return to normal. And therefore, we can raise interest rates a point this year slowly and next year, and everything's going to be good. However, if things are not going to return to normal, then something is seriously wrong. And I think that's why people are getting into gold and silver. And when I say a failure of central bank policies, the specific failure I'm speaking of is a failure to succeed at what they've been doing, of trying to return the economy to normal. They succeeded in making the stock market go back up from 2009 to 2015, from 2013 to 2014. They generated what I call the stairway to heaven rally when the U.S. stock market went up at a 45-degree angle without ever pulling back. The rally was generated by a quantitative easing program, that caused interest rates for Treasury bonds to fall, which took the interest rates for corporate debt down to almost a record low level. That caused corporations to borrow money like crazy. The problem was the economy's so weak, they had nothing to put the money into to create, business expansion. They didn't build more factories. They didn't really build much new real estate and so forth. So to take advantage of this borrowed money, is bought back their shares, their stocks, and that helped make the stock market go up. In the end, though, they created this giant corporate debt bubble. That's unsustainable. It will make them stop their buybacks, and everything's just going to fall for a very long time. So I think that's where we're headed to, and we're having this bear market rally that's making people, hear someone like me say this and just ignore it. That's what most people are doing. They don't really want to hear that. They don't want to be told to get out of the stock market or be careful or try to bet against the stock market. And that's okay. If someone listening doesn't want to do any of those things, I would just say look at gold and look at commodities and look at the opportunity to put your money into something starting in the bull market versus keeping your money trapped in something and just thinking it's going to go up against the big trend of the market that started last July. And even if it were to go up, it just doesn't have the upside. The market bottomed in 2009. If the Dow made it high, where's it going to go to? It's not going to go up as much as gold and mining stocks have done, and as much as other commodities are going to do either. So look at the opportunities. Don't just look at your investment account and be scared like, oh, if I sell or if I make a change, I'm going to miss out on my little stock, my little Facebook or Amazon, when you have better opportunities to make money at this point. And as an investor, that's what you always have to be doing, is looking at where's the next best place for me to put my money, or is there other better investments than what I own now? And right now, for almost every single person in the United States, the answer to that is a resounding yes.
Do people confuse a healthy stock market with a healthy economy?
Yes, they do. They definitely do that. And that's what's been happening, too, is the stock market went up from 2009 to last year, and they say, oh, this is great, Everything is good, but the economy never returned to normal. We never had sustainable real economic growth, real jobs growth. The government reports these job numbers, but everyone knows they're knocked up or they're exaggerated by leaving out the people dropping out of the workforce. They're at least twice as bad as what they say they are, probably 3 times as bad. Jobs, wages have not grown. It's just, it's a hard economy for people to find good paying jobs in. But people who watch these financial news programs, just see the stock market go up. They're excited. Lots of people that are invested in the stock market today are retired people that, they're retired. They don't have to work anymore. And they have most of their money tied up in the stock market. And they see the market go up and they just get happy about that and complacent and think everything's good, when it really isn't. And that's the real failure of the Federal Reserve is not the stock market. If the stock market goes down, really, it's not that big of a deal. The stock market went down in 2009, 2008. It didn't end the world. The 2000 bear market, the 2003 bear market happened. Didn't end the world. 1987 stock market crash happened. Didn't affect the economy one single bit. The obsession with the stock market is one of the things that has ruined or hurt the United States very badly. It's one of the reasons why Trump is doing so well, because those people don't benefit from this. If you're unemployed or have a low-paying job, you have no money in the stock market, and your life hasn't improved. And the only benefit the politicians really have given to the general public is making the stock market go up. That's it. They haven't created a real economic growth. This is for both parties. This has really been their program for aiding people make the stock market go up. Ben Bernanke, in fact, specifically stated this in around 2011. It might be 2012, but it's when he did one of these quantitative easing programs. He put an editorial in the Wall Street Journal saying that quantitative easing will make the stock market go up and people will feel better off and they'll spend more money. They didn't really, it ran its course. The stock market went up and people stopped spending money once it stopped going up, or the people, wealthy people that had all their money in the stock market. So yeah, it's very misleading to people, and it hasn't returned, it hasn't been able to return the economy to normal as promised. And that's the real failure of the politicians in Washington that's causing Trump's popularity. The other failure is, of course, the disastrous foreign policy wars that we've been doing since 9/11. ISIS in Iraq is a symptom of that. It's just a total disaster for the entire country, and now these people running around doing crazy stuff. Same thing happened in Libya. Obama destroyed the country of Libya. About 100,000 people are dead from that decision, and ISIS is growing in Libya now. So the country's been made less safe. So these are the two failures that we're dealing with. The foreign policy stuff, though, people don't really, it doesn't affect people's day-to-day in the United States, really. It's the economy that really matters. So that's what's driving elections, and it's what's going to drive the stock market down, because the policies failed. All they did was create another giant debt bubble, this time the corporate bond market. And, when that starts to unwind in a more dramatic way, it will hurt the economy, because if corporations have borrowed all this money and the cost of financing their debts goes up, they're going to have to cut costs. Companies are going to go out of business. Last week, or just a couple of days ago, Sports Authority announced that it's bankrupt. If you look at the news every single week, there's some big retail chain going bankrupt. So that's where we are. We're kind of like in this weird moment of time right now where the stock market's faltering, gold's going up, providing us an opportunity to make money, providing people a mechanism to escape the stock market, even inflation or either potential economic problems down the road. But everyone at the moment is kind of in a funny situation for the most part. They're asleep on the risks in the economy and the stock market, but then at the same time they're also angry about them, or the masses are angry about them because they're voting, for Trump, and also Sanders is a reflection of enchantment. The younger people that had flocked to the promise Sanders' programs.
Mike, how can people subscribe to Wall Street Window?
Just go to my website, wallstreetwindow.com, and if they click any of the posts on the front page, they'll see a link to subscribe on the bottom, and they'll get the free monthly PDF newsletter right there.
Mike, thanks a lot for being on This Week in Money.
Thank you.
My guest has been Mike Swanson, editor of wallstreetwindow.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark and Mike Swanson, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.